Since you and I both started in this business, there's been a constant debate over whether active management or passive management is a better way to invest. Here at CCR, we've always believed that neither one of them is mutually exclusive and have constantly used both in portfolios that we've constructed for clients. Where do you think that we are in this, if there's a cycle to it, or where are we in this discussion?
So you're right. It's, since I got in this business in the mid-1990s, the debate, has really kind of heated up. I think the last 20 years has seen the debate only get louder. And it's gotten louder with the advent and the popularity of exchange-traded funds, ETFs, right? So I also think the media likes to pick sides. I don't know who their advertisers are, but certainly there's a debate about whether you should be paying for an active manager or whether you should just be riding along in an index fund and paying extremely low fees. And we know the fees have been dropping and dropping and dropping,
Sure.
and even are virtually zero in a lot of cases these times. So it's you're right. Our answer to the question, active or passive, has been you should have both. The fact of the matter is, if you get inside the data, we see, and we'll show an illustration, that the outperformance or underperformance of active versus passive or passive versus active is actually cyclical. It's not static. There is no correct answer to say that passive always outperforms active. It is a performance issue. It's also a fee issue, and fees involved in investment vehicles are, feed right into the performance. It's also important to understand this debate almost always centers around large cap, kind of core stocks, in general, U.S. stocks most of the time. And the truth of the matter is the market is so much more than that, right? So we talk about efficiency, and I'd like to bring a couple things up. How does CCR use ETFs? And I like to say that they're based on some universal truths. And then I think JP Morgan came out recently with some interesting research that dives a little bit deeper into the current market and where there's maybe an impact on the active versus passive. Getting into that, understand market efficiencies. All right, so very highly liquid, highly efficient markets, and that would define the S&P 500, or that would define the U.S. large cap universe. It's the most highly efficient market in the world. What makes it highly efficient? Well, you have massive analytic coverage of the market. You've got high liquidity, which means there's a very narrow spread between the bid and the ask. And in most cases, it's a penny or even less with algorithmic trading. You have also an enormous number of participants that keep that market liquid and keep that market moving. In that type of market, it is very difficult, and all the academic research supports the fact that it's really tough to beat the S&P 500 on a consistent basis. Certainly, anybody can have a good year, anybody can beat the market over a certain period of time, but to do it time in and time out, whether we're talking about the S&P 500, the Russell 1000, maybe a broader index, tough market to beat. There are much less efficient markets that we involve ourselves in, right? We just talked about diversification. So as we go down the market cap curve, we start looking at mid cap and then very much so in small cap, you get less efficiencies. You have many more stocks than there are analysts covering these stocks. You have less market participants, which means your bid and your ask tend to be further separated. All this means is you tend to have an increase of what we call mispriced stocks. And that's where a manager doing fundamental analysis can come in there and identify a mispriced stock, a stock that's trading way too low relative to its intrinsic value. And they can provide what we use, a term we use, and I try to stay away from the jargon, but we use the term alpha, right? That's where they provide alpha.
What is alpha a measurement of?
Alpha is a measurement of the performance a manager provides above and beyond their particular benchmark, right? So if I'm a small cap manager, Russell 2000 did 10%, and I was able to produce a 12% over the same period, I've provided alpha.
Provided alpha. Okay.
Other inefficient markets are out there. You get outside the U.S., even in developed markets like Europe and Japan, you tend to have less analytical coverage. You tend to have less market participants. You tend to have less efficient markets. So we can show on a chart that there is a significant difference in, and I'll tell you what you're looking at right now, is a percentage of managers, and this chart covers different time periods, but the percentage of managers in each one of these individual markets that outperform their index more than 50% of the time. And that's what that black dashed line is. That's the 50% mark. Well, if most managers, or more than 50% of managers, can outperform the index, you would say that that's an inefficient market and you're getting a lot of alpha in those markets. And you see here on the right side of this chart, these are all non-US markets. They may be Asia, they may be European, they may be emerging markets. Also, sort of towards the middle of the market, you see the small cap space. And you tend to have better than 50% outperformance in active managers relative to the passive index. Well, that's what CCR Wealth Management does. And that's one of the universal truths I've told you that we focus on. And our investment philosophy has been out there for a long time. So when it comes to allocating a portfolio, when it comes to that large cap blend space, we're going to use an ETF, right? We want to save money. We're probably not going to beat the index on a regular basis, so we're going to use an ETF. However, when we get outside and diversify a portfolio into smaller cap stocks, non-US, we will use ETFs, but we tend to rely a little bit more on managers. And one last thing, I would mention that there is an enormous market out there that we haven't discussed, but it is one of the most inefficient markets, and that's the fixed income market. That's the bond market. Now, you can use ETFs with certain sectors of the bond market, but when it comes to a broad approach to bonds, I think most investors will get more bang for their buck, so to speak, with going with the bond market. It's a very opaque market. It's not a liquid market, and there can be enormous disparities between the bid and the ask, depending on how big a player you are in the market. The J.P. Morgan research I mentioned, I've pulled a few charts from that, and I think it's important because we can go back to the original cyclical difference between active and passive. You'll see that over the last 10 years or so, maybe not quite, maybe not 8 or 9, that there's been even bigger disparity between the outperformance of passive relative to active. And again, remember, for the most part, we're talking about U.S. large cap stocks. But J.P. Morgan's research indicates that they see a correlation with the quantitative easing that's been a phenomenon for the last 10 years or so in the market that may have caused and may have exacerbated some of these things. So running through a few of these charts, I would point out that the research shows that active managers, and that's indicated in blue, that active managers tend to outperform the indexes in down markets. Okay. Right? So on this chart, you see blue being active managers in a down market. The brownish is active managers in an up market. And again, same concept here. That dotted line is the percentage, and then that's the 50% mark. So you see outperformance in, the research showing outperformance in a down market. People might want to consider that.
Do you think that because we've been in virtually an up market for the last 8 or 9 years, that's produced this preponderance of using active, of using passive over active?
Yes and no. We've had a number of downside, bouts of volatility. 2016, last year in the fourth quarter, we can go back to 2011, where you have active managers outperforming. But the broad secular bull market, we've had an enormous amount of money pouring into specifically ETFs. So J.P. Morgan's research goes on to show as well, and here you get kind of the advent of quantitative easing. On the left-hand side, there's 15 roughly trillion dollars, that's with a T, in negative yielding debt. Now that debt's been produced by primarily Europe and Japan, but coinciding with that quantitative easing, you see that both in non-US markets as well as US large cap markets, the percentage of active managers able to beat their benchmarks has really tanked.
So you mentioned negative yields, John. Can you explain how negative yields work?
It's simple, Mark. You give $1,000 to a bank, put it in a CD, you get $1,200 back, or maybe that's a little bit high, $1,002 back. With negative yields, you give $1,000 to the bank and you get $995 back. That's a negative yield. The point of negative yields is kind of the same point the Fed had when they went to 0% interest rates here. We haven't done negative yields in the U.S., but the point is to push investors out on the risk scale to get out of fixed income and invest your money, invested in the economy, invested in stocks, invested in create some sort of economic confidence out there. Whether it works or not, I mean, I think it's pretty clear it hasn't worked. So I would not expect negative yields here in the U.S. But if we go back to some of the research that J.P. Morgan has highlighted, we talked about active managers tending to outperform in down markets. Some of the other phenomenon from this pile of money moving into ETFs is that you tend to have a lot of the market returns being driven by very small percentage of stocks. So what we have here is a contribution, and this shows a highly concentrated market. We went through the late 1990s, and the same phenomenon occurred.
Right.
It's occurring to somewhat of a less extent right now, but it is occurring. We have market cap indexes, right? The bigger the stock, the bigger the company, the more influence it has. And what we see today is companies, the top 5% of companies in terms of size in the U.S. markets accounting for as much as 30 or even 40% of the market move. So highly concentrated market. That is likely being fed by the massive push of money into ETFs. Another phenomenon is what we call pairwise trading. And again, let's remind ourselves of what we're talking about, and that is active versus passive management. Why the disparity in performance? Well, we've had, again, as a result of money just piling into ETFs, it may be broad-based ETFs or it may be sector ETFs. You tend to have this phenomenon of pairwise trading, right? If Amazon goes up 2%, chances are Google's going up 2%. If Apple's going up, or going down big, or semiconductor companies are going down big, it's tending to drag down the other big semiconductor stocks in that space. It makes it very difficult, or much more difficult, for a stock picker, right, to differentiate between the two. So pairwise trading is a difficulty for active managers. Another difficulty for active managers has been the fact that through ETFs, investors have put a lot of money into what we call bond proxies, right? And again, it goes back to quantitative easing, it goes back to this lack of a normalized yield over the last 10 years. Interest rates go to zero. Investors who have historically relied on interest payments, income from their portfolio, it's not there. So where do they go? They go to the stock market, and they go to the highest yielding dividend paying stock. So you've had this likely less than rational return profile of stocks like real estate investment trusts and utilities. So bond proxy stocks, again, evidence of another reason why active managers who may not have said, hey, this is a great value to buy these utility stocks, have underperformed the market. The research goes on. I think that this last point is particularly important. It's maybe the most anomalous result of the research. And that is that, if you go back 70 years, there has been a disparity between the general performance of growth stocks relative to value stocks. And the academic conclusion is that value stocks have outperformed. I mean, the difference in performance is accrued to value. The truth of the matter is that most money managers out there have cut their teeth and built their models based on that 70-year track record. And that track record went away. It went away, and you can see from the following chart that there's been a massive outperformance of growth versus value for the last 10 years. The only way to really explain that is to say the models have broken down, right? So is that going to be the case going forward? Well, you have to ask yourself if non-normal monetary policy is going to be the norm now going. Is that the new normal? Mm-hmm. Is quantitative easing, negative yields, super low interest rates, or even 0% interest rates the norm as far as the eye can see? I would finish up on a couple points, and number one is that J.P. Morgan and there's some other firms out there in their research have looked at the market most recently and seen possible signs that the value growth disparity may be sort of disappearing. I think it's too soon to put a nail in that coffin. We certainly began to see that a few years ago, but once again, the Amazons, the Googles, the FANG stocks quickly outperformed and dominated the market. The other thing is to keep in mind that Jack Bogle passed away earlier this year. Jack Bogle was the founder of Vanguard. He's also known as the father of indexing. He wrote an op-ed in the Wall Street Journal end of last year, right before he passed away. And one of the things he mentioned, and it was really geared towards index holders, passive investors, is that there will come a day, given the popularity and the huge push of money into ETFs and index funds, where there's going to be a small handful of indexes that own over 50% of the US stock market. Okay, and in Jack Bogle's own words, that's going to benefit no one. And I think what generally happens is the pendulum swings in one direction. Everybody owns all the same stuff in all the same proportion, and you're going to end up with much easier sledding, so to speak, for active management.